I'm not a morning person.
Welcome all to the Node. I am Mike, aka Veteran Crypto, and with me as always is David from DeFi University. How's it going, brother?
Outstanding, Mike. Even better now that I know Colin's here today. It's going to be great.
Oh, yeah. We'll stay off the topics that you and I don't agree on.
Yeah, we agree on everything. What are you talking about?
That one thing that Mike said we can never talk about again.
We'll just save that for tonight for the red pill. Let's keep it professional on the show.
It's fucking morning, man. I'm not. For me, it is. I'm a night owl, so like, if I'm not as sharp in this show as I am in the nighttime show, that's why.
No worries. All right, let me see what's going on with the arena. For some reason, it's not working, but let's go ahead and jump on into it. So those that don't know, there it goes. Colin, actually, you know what, Colin? Why don't you introduce yourself? You know, kind of what's your background, and you know, like I know that you were one of the original members at Avalanche and all that. So why don't you give the viewers a little bit of insight into who you are?
Sure. Me eating my breakfast like an asshole on the stream. So, damn it, I shouldn't have done that. Now I got meat by my mouth. This is like the most inappropriate thing I've ever done on an interview. I'm so sorry. Let's restart. And why don't you introduce yourselves?
Hold on. Slow down. Gotta let me talk. This isn't the red pill. We don't have endless time. So let me introduce the socials real quick, and then I'll kick it over to you after you chew your breakfast.
Thank you. I didn't even think. I told you I'm not sharp right now.
Oh, it's all good. All right. So if you want to join the chat, if you want to ask questions, for our show, this is where you find us on YouTube. It's at @thenode_channel. It's where you can find all of our different shows. So you can see all the upcoming live streams, which show is live right now. You can see all the past live streams. You can see all the past Node episodes, Crypto and Chill with me and Jeff on Tuesdays and Fridays at 5 p.m. The Blockchain Report, Jeff on early projects. He does deep dives. That's Monday, Wednesday, and Thursday at 11:30 a.m. Pacific. We have DeFi High immediately after this with DeFi Don. He took over that show from me and David when we started the Node. We have DeFi University with David. He does daily market wrap-ups. And so, if you're interested on, kind of what happened during, that trading day and, some charts, and he dives into basically, why the markets did what they did that day. We have Jeff on Saturday Night Fever, Saturdays at 6 p.m. Pacific, where he has DJ sets. This Saturday, he is doing an interview with one of his buddies who's also a DJ. They're going to be doing a little bit of tutorials, if that's something you're interested in. The red pill is tonight. Do not miss it. That's what we were just talking about. Usually it's myself, David, Colin, and a couple of, Jeff and a couple other people. And pretty much what it is us getting drunk, getting loose lips, and talking about a bunch of stuff that you're not supposed to talk about in polite company, and it gets spicy.
No, we don't drink alcohol.
Just do that all the time.
So I do. I don't know about you, but I drink alcohol. Maybe
too many hits to the head or something. I don't know, but like I got no filter. But
all right.
Yeah.
And then last but not least, join the Discord. That's a place where you can join the community. You can talk with other people that are at different levels of experience in DeFi and crypto. We do a great job of keeping this almost everything that we have here is cost. It has no cost to you. Can't use the F word. But by all means, please jump in here. All these links are in the description on the channel. And then, of course, last but not least is the Node. The Node.pro is our website that David's been working very hard on. And you can see over here the research links. This is all of the links of the news articles that I'm going to be talking about. That this panel is going to be talking about here in a few minutes.
Hey, Mike,
you can see.
You want to share the Node.pro website? Because now I see the YouTube.
Yep. Thank you. You can see that if I press this, you'll be watching us live. You have the live chat over on the right-hand side. Links to DeFi University, a no-cost education system that David put together with quizzes. It allows you to learn DeFi, learn about crypto, and ultimately why we are in crypto and crypto investing, because of kind of what we feel is the failing the failing dollar and the failing financial system. One-on-one private coaching with David, our AI newsletter that's about to go live, and our store. Myself and DeFi Don are working on getting that set up. It should be next week. We're going to have hats, hoodies, all that kind of stuff, all that swag. If you want to support the channel and kind of represent the channel, we appreciate the support. So with that, let's jump back on over to here. And Colin, are you ready to introduce yourself?
Sure. Hi, my name is Colin Couchet. You would not be able to get that from the spelling of my name normally, but sorry, I'm also sharing the social has me on today. Come say hi. There we go. My name is Colin Couchet. I am I don't know what to call myself. I've been a programmer for 20 years. I started in high school in the late 90s, and eventually it led me in the direction of crypto. I heard of Bitcoin early on, obviously, but I didn't think it was very interesting at the time. From a money standpoint, I was right. From a technical standpoint, I mean, I wasn't right, but from a technical standpoint, I was kind of like, it's got some features which are unique, but what I'm really looking for is some stored procedures. And so I started putting my feelers out, watching for something that had sort of a stored procedure protocol on crypto. And that got me involved in Ethereum early on. That's when I jumped in, bought my first Bitcoin, and started to, because stored procedures in databases, because that's all blockchains are, they're just databases, are basically smart contracts. And so when I saw Ethereum, I jumped in on that. Late 2015, it hit my radar. Early 2016, I bought my first, Bitcoin just to buy my first Ethereum at $2. I started talking to some of the Ethereum folks. That led one thing to another. By early 2017, I said I would go anywhere, I'd do anything. It got me involved with a group called Animal Ventures. I started working with Fortune 30, pretty much 50 to 30, Fortune 50 to 30 companies on evaluating blockchain technologies, especially in the integration of supply chain and logistics. I realized what their actual problem use case was, and it's network resilience. That's actually the big problem that they were suffering from, that they thought blockchain might be able to fix. And so that led me, eventually I worked for a government contractor doing consulting for, helping them know what blockchain is. That didn't last very long because I don't work for the government. And then I went, I wound up having this podcast called Hashing It Out, which I ran with a guy named Corey Petty for a while on the Bitcoin Podcast Network. And that we did something like over 100 and something hours worth of content, with deep dive technical interviews with the top names in the space, which led me to Emin Serer. And we, first time I had him on, he was describing something called Avalanche. And I said, I'm not sure if that actually works. And by the second time, I'd also gathered enough information that after the episode, I was like, I don't care. I want to work for you. I want to work for you. And he was like, I'd love to have you work for me. That's my goon impression. And so I sold my house, sold my car, dumped most of my stuff in the garbage can, literally took 2 tons worth of stuff from my house and put it in the dump, and moved to New York City to work with people I've never met before in my life to build Avalanche. And so I'm a founding team member of Avalanche from 2019, and I saw that network all the way through getting it launched. Worked on early consensus timing stuff, moved on to some tooling, and eventually went to Avalanche JS, where I built 95% of that code base, aside from like the standard stuff, the wallet stuff, basically. The what's it called? Whatever. And then I also helped manage and launch the incentivized test network on that. In the process, I became intimately familiar with some of the top names in consensus protocols, and that trained me up with a quickness on exactly how consensus protocols work, why they are important, what their limitations are, what the trade-offs are, and how to explain them to just normal people. That was kind of what I did for a while too. I was also explaining these problem sets to banks and stuff while I was working for Ava Labs. So it was a good adventure, but it burned me out. I left, started a brief Twitch channel for crypto, realized there's some risk involved in that, decided to leave doing that, and started doing Twitch. Twitch got me into streaming. Streaming got me into the idea that maybe we should build a streaming system that uses crypto as an incentivization model so that there's a separate way for people to monetize without having to deal with all the crap that you get from YouTube and Twitch and Kick and their payment systems, right? That led me to the Arena, and I told the Arena, if you build streaming, I'll show up. They built streaming, and now I'm the number 2 champion. I was the number 1. Somebody named WorldCoin 2020 decided to just edge me out. I think it's because they got sick of me being number 1. Now I'm number 2 champion by a hair on the Arena. Technically, I could be number 1 right now if I wanted to. I have some unstaked tokens, but that got me really involved with the Arena. That's how I met you guys, and here we are today. So that's the sum of it. I hope it wasn't too long.
No, that's perfect. Yeah, actually, we need to move our old tokens from DeFi crypto and airdrops, our staked tokens, over to the node account. So because we need to start working on building our way up the champion.
Yeah.
Ladder.
Yeah, there's rewards that are coming with champions, obviously. I mean, like, you can't... The champion rewards right now is pretty much just staking rewards. But there's a lot of reason to build incentives into the Arena around champions, because the champions are the top 500 people who are staked in the Arena protocol. And for that, I think you need about 1.2 million or something tokens at the moment. But you stake, you get, did they lower it yet to 10%? I think they did. Staking rewards used to be 20, used to be 30. So we're dialing back the staking rewards as planned, because you can't give away, you flood the market with tokens, the token price goes down, but we also, the supply for that staking needs to feed the system for a long time to keep the flywheel going. And now Arena has more than just streaming and social. Social has AI agentics built in, so you could actually do AIs, have a personality promote news to the users in the social feed. They could even technically stream if somebody worked that out. Arena has stages just like X Spaces, but there's no censorship. So you could get away with a lot more on Arena than you could anywhere else. So you could actually say and do things on the Arena that you really couldn't on these other platforms who depend on advertisers, and those advertisers themselves are censoring people and what content can be displayed and what can be actually shared. And I think that's the real value use case here, is because we have an alternate way of generating income through trading perps. We don't need to, bow to every single advertiser, and that's what's really driving all the censorship you guys are dealing with on all these other platforms. So
well, and that's why I'm so bullish on these other platforms. It's just it's unfortunately YouTube has the eyeballs. They were kind of the first ones to the party, so they have all the eyeballs, kind of like because Google owns them and all that. But it's why we're such a big supporter of the arena. Is and let Jason know. I sent him a message. I want to have to do a call with him. I appreciate the introduction, but I want to have a call with me, him, and David so that we can.
He's a busy guy. Yeah, he's working on a lot of new stuff I can't talk about. And so this is another reason to be bullish, is that I can't talk about this stuff, and he's super busy. Like, he's busy just when you talk to him, you'll see it on his face. They're working on some really cool shit. They've already announced in some fashion some copy trading, and that combined with the AI agentics could make for some really interesting. Basically, the use case of like anybody can now basically have an agent just by subscribing to an agent, and they would trade on your behalf. And I think that's an interesting approach that nobody else has done, and they're almost done with it. So like, this is very exciting stuff.
Well, let's actually circle back to this conversation during the interview portion, but I want to jump into the news, and feel free. I mean, kind of our format here is I just go through the headlines, and then usually I kick it over to David to get technical and go in depth. But by all means, if you have something to contribute, let us know. So right off the bat, it looks like the markets are in extreme fear. There's a risk-off flush going on right now. We're at 23 on the fear and greed as the liquidity crunch hits both crypto and stocks. Bitcoin is down 5.5% currently, wobbling around the 70K level. This represents a 43% retreat from its October 2025 high of 124.7. What are you seeing on that, David?
Well, weren't we trading at these levels 5 or 6 days ago?
Absolutely.
Basically, it's like
it's a cycle. It's always with Bitcoin.
Yeah, it's just like extreme volatility up and then volatility down. Look, what I'm mostly focused on is not the up and down out of BTC. I'm mostly focused on crude oil and what's going on in the Middle East, because that, I think, is much, much more important for equities and for bonds. So I'm really tracking yields and I'm tracking equities, because if equities fall out of bed and really break down below their respective 200-day moving averages, which they're at right now, trading at support, if there's a big breakdown out of equities, I don't see how Bitcoin stays above its 200-week moving average. So really,
what do you think would cause that?
Crude oil remaining at or above $100, and its effect on rates, pushing rates higher. So it would be, bond market volatility driven by crude oil, pushing, to the upside, nearly doubling over the last couple of months here. So yeah, I'm really mostly focused on the bond market right now, because bond market volatility has been extremely inversely correlated with the S&P for basically the entirety of the last year. And so when I see bond market vol, going straight up, and I see a ton of volatility in rates, that makes me think that we might be about to see, a correction in stocks this year over the next couple of months. But that's okay. We should get corrections in stocks, and it should become a buying opportunity, I think, at some point. So for me, I'm just, look, I'm short, and last couple of days have been great. So I would like to see more downside.
All right.
I mean, speaking of the market, I mean, like the AI stuff should be impacted by all that as well, considering they depend on electricity. Yet, for some reason, despite every single influx in the crude oil market and the energy dependence in AI, all my AI stocks are just still steadily climbing up, week over week. And so they're down a little bit today, but I'm still up like 10 grand on many of them. So and they keep so I'm really I look at the whole world market and I go, anything dealing with AI, whether it's in crypto, whether it's say anything that touches that is still gold. And I don't see an end to that. And we keep crying bubble, but we are actually finding a lot of use cases there, especially in the crypto space.
Well, so the use cases, Colin, that's really interesting. Do you think that the use cases are going to drive enough revenue for these hyperscalers to justify the CapEx?
Well, let me do this.
I think it reduces costs, reduces overhead significantly.
Yeah.
Let me read this headline really quick, and because you guys are kind of transitioning over to a topic that this is a part of.
You know how I do.
Crypto.com announced it is cutting 12% of its staff today as the CEO pivots the company toward an enterprise-wide AI integration. So, go.
Which one was that, Mike? Which business?
Crypto.com. They're cutting 12% of their staff as the CEO pivots to an enterprise-wide AI integration, which, I mean, this is happening all over the place. We're not the only ones talking about it. We've been talking about it on our previous shows for a year and a half, or more, about, kind of the coming AI and not replacing, blue collar jobs, replacing white collar jobs. And a lot of people are talking about this now. So, please continue your guys' conversation about AI.
So it looks like the CEO, Chris Marszalek, is, cutting 12% of his workforce, right? So that's 180 employees. But this is part of this ongoing trend, right, that we've seen over the last, really accelerate over the last couple of months. You got Block, cut their workforce in half and said, hey, AI. Now you've got Crypto.com saying the same thing. You've got Meta cutting, 20% of its workforce. And it seems like it's just...
Well, they're dialing back VR.
Yeah. It seems like it's just getting started, right? Don't you think that this accelerates?
Yeah, I do.
Yeah.
And I would have... so everything looks like a bubble and this big feedback loop, but I don't know if that's true this time, because the problem is that the external variable is that human capital and knowledge capital has dropped to zero. And so we're facing a world we never saw before. A lot of the new revenue is not revenue. It's existing revenue being allocated towards growth and instead of overhead. And I think that that's a new paradigm we've literally never seen before. The closest we've seen is automation in the 80s. But that's not even sufficient to account for the amount of change we're seeing here. Lawyers are at threat. I'm a programmer. I built Adigo.bid in a month, and that would have taken a year. And I built it by myself, and it would have taken a large team before. So I mean, like, this is blowing my mind. Like, my whole worldview has flipped upside down. I thought coders were going to be one of the last bastions because of the halting problem. It wound up not being the case. All we need to do is add probabilistic factors into these machines, and suddenly they could be just as good as humans. And by the way, one of the arguments I keep hearing is that people demand perfection from these things. But what winds up happening is, if you make it as good as a human, you get as many bugs as a human. But if you make it faster, right, you can iterate faster and prototype faster, and that makes it better than a human by about 1,000. So if I'm able to do in 15 minutes what would have taken me a week to 3 weeks before, and I have the same amount of bugs, and it can correct those same bugs, it's better than a human already. And that's where we're at right now. So knowledge work is going out the window, man. We're going to Star Trek world, and its post-scarcity is on the horizon, and I don't know what that's going to look like for the rest of us. I feel like we're all looking at being in a surf class, and knowledge is going to be commoditized.
I want to back up a little bit, because I don't think you did it on purpose, but I think you glossed over an important and a very valid point that I really haven't heard anybody else talk about. And what that is the revenue, or the money that used to have to pay, for salaries and things like that for these people, is now being looped back in to growing these technologies, to building out, better systems. and accelerating the change. I mean, I think that's what you were kind of
Yes.
hinting at
Yes.
and moving past. So, I mean, David, kind of what are your thoughts on that? Because we've talked about this on the Red Pill and stuff like that on tonight, by the way, where a lot of these revenues and people have talked about a universal basic income, because once AI replaces a bunch of thinking jobs, white collar jobs, and robotics takes over a lot of blue collar jobs, construction and things like that, then what do people do? How do they survive? And there's going to have to be some sort of universal basic income. Don't necessarily want to go down that rabbit hole right now, but what do you feel these companies are going to do with that freed up revenue, and how is that going to affect their stock, their stock price and things like that?
Right. So, I think it's easier for me to think about this if I think about who are going to be the losers rather than try to predict the winners. I think it's a little bit easier to look at a handful of industries and say, like, hey, these are likely going to be, impacted significantly as a result of AI, and this year too. So I'm thinking like customer service. So, replacing humans with AI multimodal agents. For example, Klarna's AI is doing the work of 700 human reps. Okay, so that's pretty cool. Customer service impacted in a big way. You got finance and accounting. So automating bookkeeping, automating tax prep, automating like routine auditing. So finance and accounting firms are going to, come under some pressure potentially. You've got software development, right? And so Colin is very familiar with this, right? The efficiency gains in coding allow one engineer to do the work of 10 or 20 or maybe more than that. You've got legal support. And, Mike, we were talking with your brother about that earlier this week, where, AI is handling document discovery, secretarial tasks, initial research. So, lawyers could be coming under pressure too. And then also manufacturing.
You just got done building our AI team.
Yeah. And so that's something we can talk about, those claws, those agents. That's really cool.
Let's circle back to that after the news. I definitely want to get through the news because I know that we love nerding out and we'll go down a rabbit hole and never come out. So let me move on in the news, but let's definitely circle back to this.
Yeah, most definitely.
So regulatory, the digital commodity era begins. We talked about it yesterday. Solana and I believe it was 15 other assets. The SEC has officially classified alongside Bitcoin and Ethereum as a digital commodity. Don't know if I agree with it, but that's what they judged it as. This removes the security label that haunted the project for years, potentially paving the way for Solana ETFs. Airdrops and staking. The new interpretation explicitly states that airdrops, protocol mining, and staking do not constitute investment contracts. This is big, effectively ending years of legal gray areas for DeFi users. And let me explain why this is big, and I'm going to kick it back over to David. So it's important to understand that if it was an investment contract, that has tax implications and that has other legal implications. So potentially, what this means is that if you're farming airdrops, if you're mining these different projects, and if you're staking, that does not constitute an investment contract. So David, what are your thoughts on that?
Yeah, I've got a lot of thoughts on this topic, Mike. Can you bring up on the screen what I'm sharing right now? Because it is those
Absolutely.
16, the Sweet 16, according to the SEC and the CFTC now, apparently. So, yeah, I don't know that I really understand the attach-detach mechanism that they're talking about here. So, Mike, I really want everyone to be able to
Yeah, you're going to need to reshare your screen. It's not wanting to share.
Got it. So, and Colin, I want to get your input on this. I want to hear what you think about this, because have you seen the Sweet 16? Those 16 that were selected to be like the only digital commodities recognized so far? No. Okay. Yeah, it's not Mike. It's not sharing. It could just be the way that we're on the screen. If you try maybe like that, and then
all right, there's that. Now let's go back to this. There we go.
Okay, awesome. There it is. So check this out, Colin and Mike. This is pretty cool. So these are the Sweet 16. These are the 16 recognized digital commodities. Now, how the hell did Doge and Shiba Inu get in there? Okay. But then also you've got like Litecoin and Bitcoin Cash. Okay. And then HBAR, why? And then XRP, XLM, and Polkadot. I mean, really?
I know why. It's politics, and I know exactly what's going on here. I mean, Doge, obviously, Elon's involved. Shiba Inu, huge involvement from anybody touching Ethereum. They actually are very intertwined. Litecoin, just probably because of bag holders. Bitcoin Cash, probably also because of the same reason. Yeah. HBAR, I could tell you, like that Link, we understand, right? You're not questioning Link. Right. HBAR is an enterprise platform. The reason that they actually have people looking at them, well, I mean, there's particular regulators who I have met who have like a little bit of a crush on the HBAR guy. And so like, really? This is, why? Yeah, why really, I can't talk about it, but there's like literally politics involves every decision that's being made in all of this. Like DOT is crap, right? But it's still there, right? They stuck it in because bag holders are actually really important people because they got involved with Gavin Wood early because he was a co-founder of Ethereum and he spun off his own thing. And so they invested in that thing. I'm actually surprised that like Definity's not on there, to be frank with you. Not because Definity's good. It's actually not, and everybody knows it. But the amount of the bag holders on Definity are actually really high profile. I mean, like the highest profile, or like Rothschild's profile. So like, yeah. Wow. So like, I'm actually surprised they weren't on there. But it really does boil down to politics for most of this. These decisions tend to be very arbitrary. They cannot understand this stuff fast enough.
Right.
And so they rely on advisors, and those advisors advise people who have bags. And I think there's a lot of other reasons too. There's, for instance, the decentralization of a project impacted whether or not it was in those top left ones, right? So, I mean, obviously that matters, but it is ultimately also how long it's existed, how much it's tried and tested, right? These things are true too. Doge has been around for a very long time. It obviously works. Litecoin has been around for a very long time. Obviously works. People are using it for the use cases that are under that category. But at the end of the day, there's a lot of tokens like that, and they're not there. So right. It really does come down to how much brain power could they put in to pick the top 16? What were the politics involved with that? And that's what got them up there.
Yeah, so I've actually, in this slide deck here, Mike, I've got some more content about attach, detach, and this, going from SEC jurisdiction to CFTC jurisdiction. And, I understand the idea behind it, but man, if you apply the CFTC's own logic to the Sweet 16, well, here's the logic that they applied right here. Nakamoto coefficient, Gini coefficient, developer activity, and geographic distribution. I don't see how these Sweet 16, meet those criteria to become like detached digital commodities. So yeah, it seems to have been completely arbitrary. And
well, I think it's exactly what Colin said. I think it 100% is political. It's whoever had the deepest pockets, the best lobbyists, they own the most politicians. I think that really is what it boils down to.
But I also think this is just the first, and they had to pick the thing that would get this project rolling and going in this direction. And that is a political choice, and that's okay. Like Avalanche's Gini coefficient is not strong, right? It's not nearly as strong as I would like it to be, right? But that's just that. But it is what it is. But our Nakamoto coefficient is the largest.
Well, really quick, Colin, it's David was talking about that yesterday. Can you just briefly explain what the Gini coefficient is?
Sure. I mean, it's basically a distribution of power. It's a governance distribution. Now, they use tokens as a method of deciding this. For instance, how many people of a certain group own the staking rewards in this particular staking protocol, right? So if a cabal of people, whether or not they are diverse, like let's say all the founding developers own 80% of a protocol that has 80% of amount of decision-making power in order to basically make a change on the network, then that protocol has a Gini coefficient of like 9, I think it's like 98. And so like, I think maybe I got that number backwards, and it's 2%, whatever. But the point is that it's basically a power distribution, a governance power distribution of how much wealth or power is concentrated in as few hands as possible. And so,
decentralization measure.
So like Bitcoin might be highly decentralized. Anybody could jump in, anybody could jump out, right? But if only a handful of people are producing the ASICs and they decide who gets to be the next big Bitcoin miner, then that, in my opinion, means the Gini coefficient is fucking zero. You see what I mean? And so like this is kind of like the real intent of the Gini. Now, it was originally based around distribution of wealth in terms of the US dollar, for instance, in any fiat currency. How is wealth distributed over an economy, right? But in terms of what it means for crypto, it's really a power distribution. And so that's what it kind of amounts to.
So Colin, you're a developer. What do you think about the developer activity on some of those other chains, some of those other projects? You know, like what is the developer activity looking like on Cardano or on Ripple or on Tezos?
Let me ask you something. If a protocol depends on a third party in the chain in order to actually have activity for developers on that chain, right? Would that developer activity count? In other words, if I need IOHK to fund my project in order for me to even have a project on ADA, does it count as me being a developer with developer activity? Or does it just mean that I am a subsidized government organization and the government is IOHK? You see what I'm saying?
Yes. Yeah, it means that...
so it's nonsense
organic.
Metrics.
It's not organic.
Most of the time it's not. But with things like Bitcoin, it is. And so I will give Bitcoin props on that. Things like Ethereum, it is. I will give Ethereum props on that, okay? Things like XRP, it's not. And so I'm like, and Avalanche needs a lot of subsidies too. And that's just one of the weird kind of like it's kind of like that threshold where once you get a certain amount of adoption, the developer activity becomes more organic. But that number used to be down in the 20s for any protocol on top 20 protocols. Now it's all top 5. And so this is the direction we're going: consolidation of wealth to top protocols, and that's going to be, that's a hard problem to crack.
Well, let me ask you this question, Colin. What are the chains that are attracting most of the actual organic development?
I'm not going to lie. There is some organic development on Avalanche simply because of the novelness of the protocol, and you can do things on there you can't anywhere else, but it's not nearly enough. And so I'm not going to put myself in the top 10 on that. I'm going to say that Ethereum, maybe top 10, but not like top 5. The Ethereum is definitely organic. Okay. Bitcoin is definitely organic. I don't think XRP is very organic. I don't think HBAR is very organic. You know what I mean? I don't know how to answer this question precisely. I would say Hype is very organic. Hype is getting a lot of organic developer growth, right? A lot. So that's good. Solana, obviously, is getting a lot of organic developer growth. I would actually put, let's see. Let me look. I got the list up here. So Bitcoin top 5: Bitcoin, ETC, Sol, absolutely. Hype, skipping XRP. Hype. Doge doesn't need organic growth at all. BNB doesn't need organic growth. Oh, BNB has some organic growth actually. So I'll put BNB number 4 actually. I would put them number 4. BCH doesn't need that. SUI, I don't think they have organic growth, but they do have some developers, and I would place them about on par with Avalanche in terms of that. And then Link. Link obviously has a tremendous amount of organic developers who need their tools.
So Colin, you mentioned, SUI being on par with Avalanche, but, Aptos, which is basically the sister chain to SUI, kind of, sort of, Move programming language. It's like similar guys. They all came from that Facebook project, right? So that Aptos, they made it into the Sweet 16. SUI did not. What do you think about that?
SUI, I don't know, but SUI has a definite problem in that they're not decentralized.
Right.
So they're running the same protocol that Diem Libra ran, okay? And all right, so a little history on consensus protocols. I don't actually want to do the full history. I'm going to talk about the history in modern. So Cosmos created something called Tendermint. Tendermint was an early inspiration for what became Hot Stuff, which is a formalized version of Tendermint with pipelining, okay? And that was written by Ted Yin. Ted Yin is a PhD from Cornell. Hot Stuff is written by Ted Yin from first author is Ted Yin from Cornell. Ted Yin is actually principal engineer on Avalanche. So the reason that people aren't using Hot Stuff for the use case of decentralization is because it degrades in time to consensus finality. So it's a P equals 1 means 100% probability of finality in the event that the assumptions are held true. I don't want to get into too many details on that, but there's basically, like, you can think of it like there's 100 seats, and if you go beyond 100 seats, it starts degrading down in performance, right? And it doesn't scale past that in terms of consensus. 100's a lot, but it's not nearly enough for a decentralized global platform, right? Decentralized global platform, you want the ability to hit 100,000, right? Not 100.
So that's the problem with SUI?
That's the problem with Aptos too. Yeah. So, like, I'm not really sure what their metrics were for that. Again, a lot of these decisions wind up being political. And, if a government agency is heavily already integrated with a particular platform for whatever decision-making process happened 5 years ago, this is, or they want to encourage a particular new virtual machine that runs Move, for instance. They just want to have something other than Ethereum as a backup, right? Like, this is the kind of things they might do. And so it's not necessarily like gonna make sense all the time, but they just picked the first 16. That's my opinion on this. And so this list will get bigger, and you should look forward to that.
Yeah.
What we need to do is see what the impact of this list has on price action, and then use that list as it grows to be sort of a price action predictor in the future if you're looking to do any sort of trading on this.
So, Colin, what's funny about the price action part is that it's basically marked in immediate term top. So, Bitcoin and
sell the news every time. Exactly. Sell the news
exactly
every time. I mean, I think we've got a long way down to go on the market, but I don't want to get into like my predictions on that because I don't have. But like, if you do look at trends on this stuff, the trend line is about 12 to 18 months out, I think, for market bottom, and we haven't even hit 12. So like after all-time high peak on a 4-year cycle, if you believe in the 4-year cycle, which I don't.
I do. I have to, even though I don't.
But at this point, it's no point in arguing it. If everybody believes it, it's going to manifest. It's nonsense. It doesn't have to be that way, but that's what it is. So, like you're looking at 12 to 18 months, maybe even 22 months out before the most lowest low. And then it goes, and then it's just up from there. So we're not even there. We're still in my opinion on the downtrend. What we're seeing is a typical March bump, prior to tax season. And so I'm just holding things in AI stocks at the moment. I'm trying to get some yield. But yeah, I mean, like this is typical behavior of this market. That's it. That's all there is.
We should have some type of a trough, if the cycle is going to hold, we should have some type of a trough by November of this year, don't you think? By like the middle of the fall.
Is that about 50K? Because that's what I'm estimating.
Yeah,
somewhere in the 50K range. We're looking at maybe. Yeah, is that 47? Yeah, that sounds realistic.
Yeah,
sounds realistic.
Ben Cowan this morning, I was listening to him, and he was reemphasizing the that 50K range and potentially a 30K range. If it gets extreme.
Yeah, I don't think it's going to hit 30, but I don't think it's going to hit 30 simply because there's too much market momentum elsewhere, and also we do have the AI agentic boom, which is going to prop up. It's literally happening before our eyes.
I know
AI agents are going to be the primary users of crypto. And this is why Arena, for instance, has gone so deep on agentic integration, is because this is the direction things are going. Agents are outperforming people by a wide margin. People are going to notice. These hobbyists are going to start changing their hobby. Their hobby is going to be discovery of the best agent and when to use them. It's going to become, right now we're at the base stage where we're going from just the normal, curve to the first integral. And then the second integral of this will be, basically the area under that, which is how can I write algorithms which select the best AI agent for these market conditions. And that's what the trading is going to look like in the future.
So I'm curious, Colin, what do you think about what Jensen Huang had to say the other day, where he's calling this a renaissance? He's saying that these SaaS companies that have just been getting smoked over the last year or so, that they're going to transform into ass companies. So go from SaaS to ass, agent as a service. What are your thoughts on agent as a service?
I think they need to change that acronym, but
I know.
That is true. Agentic platform is probably the best term to put it, because it's true. Which is why I built Adago, which I didn't talk much about, but it's why I built Adago to target both the humans so they could understand what's going on, and the agents so they could integrate. It's built for using X402 payment system, built for agents to use my platform to make better decisions cheaper. If it's cheaper for them to make good decisions by getting the data faster without having to parse every single API and just get the important information they care about when they care about it delivered to them quickly, then I'm targeting the agents. I'm not targeting humans. Humans can't respond fast enough. Agents can.
That's a really, really great way of thinking about it. So your target customer is not a human even necessarily.
A little bit, but not enough. It's enough to get them hooked. But it's really the agents. I care about agents.
Well, I think that the functionality is geared more towards the agents, and the end product or the product itself is for the people. But
I'm for the people.
Well, the comprehension of the product is for the people, and the reason is because I need them to notice it. I need them to be able to use it too.
I'll set up a time for a call. I wouldn't mind actually going through what you've built and discussing some stuff with me, you, and David.
That sounds awesome. I'd love to.
Okay.
I'd love to learn more about how to build for agents, because I've got to think that's going to be where you want to be building now.
Well, that's a big part of our business model. Here at the Node is just technology. Obviously, and David just got done with Bob in accounting. He has a team that's going to be basically doing a lot of the nug work for us. A lot of the day to day. 24/7, 365, freeing us up to focus just on the best quality content. So we definitely want to keep our finger on the pulse of how all of this evolves. But let's move on. I mean, we'll be able to come back to this in the next part of the show. But let's finish up with the news. So this is something that I know that both of you are going to have a lot to talk about. So the topic in the news is security, the high cost of exploits. So ImmuneFi released a report this morning that shows that crypto hacks so far in 2026 are averaging about 25 million per exploit. I know that obviously both of you have an interest from different viewpoints on this. So David, from the viewpoint of somebody that basically makes your living in DeFi, what are you seeing when it comes to security and exploits so far this year?
I mean, look, the vast majority of the stuff that I've seen have been user error or social exploits. I mean, that's usually what happens. I don't think that the majority of stolen funds, and now I could be wrong here, but I don't think the majority of stolen funds happened because of some type of smart contract exploit or, something along those lines. I think for the majority of the exploits, it's really just like, phishing, that someone fell for it and sent their digital assets to someone else, unknowingly. So, yeah, I mean, what I'm reading here about ImmuneFi, though, is about the whale effect in hacks. So it's saying that, from 2025 to 2026, over the last 2 years, there have been 191 incidents, resulting in $4.67 billion in losses. But the 5 largest exploits accounted for 62% of all stolen funds. And there was that one, remember Bybit? Remember how they got hacked for 1.5 billion? That was 44% of all losses in 2025 alone. So you get these like really, really big exploits that make up the majority of all stolen funds. So the median hack dropped to $2.2 million. Can you imagine, getting hacked for $2.2 million? I mean, that would just be devastating. While the average hack still remains high at $24.5 million. So
I wish I had $2 million to have stolen.
No, but here's the thing, though. The centralized exchanges are still the target. So out of 191 total incidences, these, despite this big focus on DeFi, centralized exchanges took the hardest hits. Those 20 incidents on centralized exchanges accounted for $2.5 billion. That's more than half the total industry losses. So,
but is that a result of a softer security measures, or is that a result of that's just where the majority of the liquidity is? So that's where the scammers and the hackers are focused.
It's human factors. That's what it is. So these centralized exchanges, remember, there are humans at the end of the day that hold these keys. They're on the multi-sig. They can sign. They can move funds. So hackers go after the humans, and they go
after the weakest link, the chink in the armor.
Right.
And that is
using phishing or compromising employee devices or social engineering targeting developers at these centralized exchanges. So the human layer is what needs to be patched, I guess you could say.
All right. So next up, we have institutional staking. Ethereum developers are pushing for one-click staking for institutions using DVT Lite technology to make it easier for banks to secure the network without technical hurdles. I'm going to kick this one to you, Colin. What exactly is DVT Lite?
I don't know. I've never heard that term before. I can look it up real quick. What is DVT Lite? Yeah. What is DVT Lite? LITE or LIGHT?
LITE.
It's a distributed validator technology, Colin.
Interesting. It's a lightweight, portable, drug-free medical device used to prevent deep vein thrombosis.
I don't think that's what they're talking about.
Yeah, this is new stuff to me. Like, it seems like people come up with new terms every freaking moment, and it's just a repackage of old stuff typically. This sounds like it might be. Like, they add one little piece of, like validation, oh, we have ZK now, so we're going to rebrand it as, it's like the same process, same thing. It allows multiple independent machines to collectively act as a single validator. We already do that on Avalanche. Like, We literally, well, except we don't have the machines basically doing the processing. Nobody needs this. Like, let me like, Ethereum's not hard to validate, guys. Like, it's not costly to run an Ethereum validator, right? It's just
32 ETH though. 32 ETH is a barrier.
But that's the part
people.
that's costly. Yes, the staking amount is what's costly. And so what we do in an Avalanche, and I guess they're doing it now in Ethereum, is that the validators, so distributed validator technology still sounds like, now I'm not going to say I'm an expert on this, and this is just a one pass like me check. Distributing the validation process doesn't seem like it's going to help a whole lot. Meaning that if like, oh, I'm running machine and you're running machine and we're distributing the validator and we're all putting it together to make one big staking pool. I don't know. Like, it doesn't sound very useful. But actually contributing to a staking treasury and basically saying, hey, I'm going to delegate, which is what we call it in Avalanche, delegate some cash, some amount to your validation pool, so you get extra rewards and I get extra rewards and you just take a little cut. That's what we do. And that's all you really need, because validating this stuff is not computationally expensive. And so I'm not really sure what the ultimate purpose there is, other than getting more people invested in the protocol and wanting to stake. So I'd have to look into the technical details on this as to why they would just name it that. But from my perspective, all you really need is to be able to create like a little mini treasury for your validator, and more people can add to that treasury and you get a little cut of the things they add to it. And
so Colin, what they're, I think, trying to do is distribute the validator set, I guess, across many, many more people. So that's what they're trying to do.
Lower the cost of a validator. Like, this is what's bothering me, is basically they're creating mining pools, and like, I don't know, like, just lower the cost of a validator. 32 ETH, make it 1. That's what I don't understand about this. And so
that's what this technology does. It makes it such that, an individual from home with 1 ETH can become part of a validator pool.
But that's the thing, is you need one validator to do that.
Well, isn't the 32 ETH, and I could be totally wrong, but I mean, isn't that for basically what they have to stake, so that if was it slashing, if they do something malicious or something like that, that's basically the fee that they pay.
Slashing's not necessary. We've been arguing with Vitalik about this for ages. They're wrong. They're just flat out wrong. We don't do slashing on Avalanche, for instance. You don't need to slash. Right? Like, it's not helpful. It doesn't do anything. You just bench them. If they're not performing correctly, the rest of the network says you are not performing correctly. They bench the validator. They don't get rewards for a bit. That's what you should be doing.
I kind of like that more than like losing your asset. Yeah.
You don't need to do that. If you're not doing the work correctly, the network will detect it and they'll just boost you.
Everybody votes to put you in timeout. You need a minute. You need a nap.
It's still a penalty, like not earning on your asset. Yeah. That is still a penalty, but it doesn't mean you lose it. Yeah.
No, I like that.
Yeah, it was never essential. And like, they just got it all backwards in their head. This is Ethereum in a nutshell, right? Like, they make an assertion, they never test that assertion, and then they go down this rabbit hole and then they marry the assertion. Like, this is the difference between scientists running the show and like goobers. So like, this is you don't need to slash. But as far as the DVT stuff goes, all you need is to say, hey, you're a validator. You're doing this work. You got your 32 ETH in there. You've got good uptime. You haven't been benched in a while. You're running all the way through March next year. I'm going to stake with you all the way through October. And you add to their stake. They say, okay, I charge a 2% fee for you to do that. And then anytime there's a staking reward, 2% of that staking reward goes to the validator you've just added money to. and the rest goes to you for that allocation that you gave. Meanwhile, the rest that they have, they get 100% on. And so if you, the 32 ETH that they put in, 100% of that validation reward goes to them. And anything on top of that, because of the additional delegated stake, they take 2% of that, and like 98% goes to you.
Pretty cool.
You don't have to run a machine. Like, that's literally the whole, that's all you need. That's how Avalanche is built. And like, we thought of this years ago. We went down this rabbit hole and discovered this is the optimal solution. So like, this is like, I'm not sure what they're doing here. If they want more machines validating, lower the staking cost. Like, that's what you should do. That's the principled approach. But
yeah, it's like you said, somebody comes up with an idea and, it's they marry it. It's something that happens in government quite a bit, as you well know. Somebody, entrenches themselves in an idea because it's their idea. Their ego gets the better of them. So,
yeah.
Well,
This is the problem with centralized anything, and that shows you that Ethereum is actually centralized.
Well, but
in a
it
way.
does look like they're trying to improve upon that. Did you see that new manifesto, Ethereum
Nope.
Foundation manifesto? So a couple of days ago, they came out with a 38-page manifesto, which outlined core changes that they want to make. So number one, they're focused on this crops now, which is, it stands for something. So it's censorship resistance, capture resistance, open source everything, privacy, number one, and security. So that's the core pillars. And then they wrote in about
What changed?
I don't know. And then you got
Were they not doing that already, or trying to? You know what I mean? Like, this is marketing material, guys. Like, this is what you got to understand. Like, they're not changing shit. Yeah. This is marketing material so that people like your audience reads it and goes, ape into Ethereum. They're going hard on censorship resistance. Like, what were they doing this whole time if they weren't doing censorship resistance? That's been their whole shtick this whole time. Like, come on. Like, I don't know. I haven't read it. I got to stay open-minded about stuff. But, like, guys, like, they do this every year. Like, you know what I mean? Every fucking year. Especially when they're down bad. Like, they do. They got to bump the coin price. They got to say, hey, we are working.
And that's a key thing that we like to emphasize here is, when you see these, a lot of the, these, news articles about, the things that are supposed to be exciting, these partnerships or, these upgrades to the technology and stuff like that, you really have to, at a bare minimum, at least put it into an AI and just say, what does this actually mean for the project and me as a token holder?
And you got to challenge the AI, because the
absolutely.
AI is.
I'm just saying, you can't just read these and think, like you said, and you can, invest in, buy the rumor, sell the news, but you need to understand that's what it is, because almost always there's a pump leading up to some big announcement, and you have a lot of the big token holders that are waiting for everybody to FOMO in on the news. And they're selling off while everybody retail is buying in, because retail's emotional. They're looking to get rich quick.
So, like, the one area that I think improvement could be made across all of these chains, all of them. Like, this is the one thing that will be a game changer if it was very successful and really worked for real people. Enjoy mentioned this in the arena chat just now. I'm sick of gas fees. But he's not sick of gas fees. We need gas fees, and he wants gas fees whether or not he realizes it. It's what stops the network from being flooded with junk, right? But we need gas fees to be pegged to the dollar. That's all we really care about. And like, this is the issue. We need it to be relative to the dollar, not relative to the root asset, because if the root asset goes up 10x, suddenly your gas fees go up more than 10x, because now there's more usage and more competition, and so your gas fees go up 100x. And this is a problem.
That really is an interesting point, because a lot of these gas fees are they I'll leave it at that. I don't want to dive into it because I honestly don't understand it at as a deep of a level as you do, but I do understand the pain of gas fees because when I first got into crypto and I was buying, Shiba Inu, because that was my first asset that I bought, I didn't understand gas fees because I hadn't done my research. And I was moving everything because everybody says not your keys, not your crypto. I was moving everything to cold storage and I was paying hundreds of dollars in gas fees just to move things, and I wasn't watching what was popping up, and I was just clicking because I didn't know that there was something called gas fees. Nobody mentioned that part of it, and so no, that's why I'm so big on things like DeFi University that teaches these new people, and that's why I started this channel was to help people on board to this new technology, but in a way that helps them to not make the same mistakes that I and many make by aping into these hyped up projects and not understanding hot wallets and cold wallets and things like that and gas on some of these different projects. So I mean that's why we're here. But let's hit a couple more of these. I wanted to shout out to the arena. Got a bunch of people watching over there, and a bunch of people watching live across the different socials. But if you would like and to join us over here on YouTube or in the arena, then download or go to the arena arena.social and find us at the Node channel and jump in the chat, or if you prefer, over on YouTube at the Node_channel. And again, jump in the chat and ask these gentlemen questions because that's what a lot of people like MI was talking about gas. It gives Colin and the other guests the opportunity to address your questions. So
and speaking of questions, Mike, I've got a bunch of questions for Colin. Like I prepared like a whole interview for him.
Well, and we got a whole hour of that. Let me finish off these last news articles. We got Hyperion DeFi currently trending on social media ahead of their NASDAQ earnings call next week. The market is laser focused on the hyperliquid or hype treasury holdings. What are you guys seeing on that? And then we'll pop over to the interview.
Well, I don't really know much about Hyperion. I've seen their protocol. I think on Pendle, I want to say, but it looks like they've got a massive hype position. So 1.86 million hype tokens worth $64 million. So hey, that's great. It's probably one of the few altcoin treasuries that has actually performed well. I mean, think about it. Like, how many altcoin treasuries are there out there right now where they've been down only, basically? Even the Bitcoin treasuries, So for one of these, businesses to have a massive hype treasury and for that to be outperforming everything else, that's great to see. But the bottom line for me is that even though hype and hyperliquid generates a ton of revenue, and they do a great job of returning that revenue to token holders in the form of token burns and buybacks, I've got to believe that even though hype is outperforming Bitcoin right now, if Bitcoin really takes another leg down and moves down towards, below its 200-week moving average or down towards 50K, I don't see how hype could continue to outperform. I mean, hey, it could outperform Bitcoin, but will it keep trending up? I don't think so.
I think it's going to benefit from whether the market goes drastically up or drastically down. And the reason being is hype is a perpetuals platform. And the buyback is, now, if you talk about hype's price, I'm not sure. But there's my take on it is people make money going down the market. People make money going up the market. That's hype's use case. They suffer in chop. And so I do think that what we're looking at is they have a buyback system. As long as that buyback system continues to make sense, that's fine. They're going to be pushing their price of their own token up. It's literally the best marketing strategy they have. And so, I mean, like, I don't know what to say, but like it works. It's Ponzi though. It feels very Ponzi. But then what in crypto doesn't? So like I'm they if people are trading on Hyperliquid will go up. As long as people are using it and they keep buying it back, then it has no choice but to remove supply by buying it back, and that makes price go up. If people stop using it, the moment they stop using it, it will go to zero. That's the only way to look at it. Like,
it's a great call. Yeah. So what could kill Hyperliquid? People
stop using it.
Yeah.
Another Hyperliquid that's better, but I don't know what would make it better because it would be iterative and not 10x. So like this is the question is, are people going to continue using crypto? Like that could be one thing. People stop trading crypto. That would tank Hyperliquid. Fine. But like you see what I mean here? Like this is their risk model is very interesting in that it does depend on usage. And so as long as people want to trade perpetuals and they want to use a decentralized protocol like Hyperliquid, and by the way, AI agents love that shit.
Yeah.
Then it's gonna go up. Like I don't know. I don't make price predictions very often, but I'm having a hard time seeing the breakpoint here. It's not like Luna where mindshare, like that's it. That's exactly it, Big Lou. Like if they lose mindshare, their token goes to zero. You can't control that, right? But you can point out the fact that they're the only ones doing what they do with any level of success at the moment. So monitor the use. That's the way you determine the price on this stuff. Monitor the use. Are people adopting it? Are people continuing to use it? Is it getting integrated? If that's the case, and they continue their buyback program, it's going to go up.
Absolutely, and that's the data. It's unemotional. It's it's pure logic. Look at the data. Verify the data, of course. But is it growing or is it contracting? Is it rolling over as far as TVL, as far as volume, things like that. Keep an eye on all those data points, just to keep your finger on the pulse. But let's go ahead and transition on over to David, and he has some questions that he's prepared for Colin for the interview.
Some questions.
Got some questions.
That's right. So Colin, I want to learn more about your experience in the early grind. I want to learn more about your origin story at Avalanche, just a little bit. So, like, what was the biggest technical hurdle that the team faced in the early days of Ava Labs that the public might not know about? I'm kind of curious about the origin story stuff.
So the funny thing is that Avalanche is actually really easy to implement. For the protocol itself is not, as far as like. It's a very simple primitive, unlike many things in this space, which are just Rube Goldberg machines. This is a very simple primitive. And so we had a primitive version of a testnet running thousands of nodes globally distributed before I even joined through research programs from Cornell. And those took a month or two to throw up, right? They weren't difficult. They had the resources. It was easy. Ted Yin wrote it. I don't think from a technical standpoint anything wasn't super solvable. The problem was building a platform. The problem was building something that people could ingest and use, and figuring out what people would use. I think one of the hardest things to develop in the entire platform was the X chain. And Stephen Butoff and I used to joke that the X chain is the best designed protocol virtual machine that nobody will ever use. Huh. And it wound up being true. Even as we were building it, we were like, we were joking, this is the best designed thing that nobody will ever use. And this is always kind of a problem in spaces like this, where you can design things technically, but they're too difficult for people to adopt. And so nobody wants to use it. I think the UTXO system is very difficult for people to adopt, and that's true on Bitcoin as well. It's a reason why Ethereum went to the account model instead of the UTXO model. which I guess a lot of people might not know what that means. And I don't really want to explain account versus UTXO here because it's a deep dive that I think would make people's brains melt. But
Probably.
It's easy if you're curious to look up, crypto UTXO versus account model. And you can learn what these virtual machines are doing behind the scenes. The X-Chain is a UTXO model, which made it very difficult for people to adopt, but it is extraordinarily efficient. And it is the reason why we can make the claim that we support, on launch day. Now it's probably even better, but on launch day, 5,000 transactions per second. And legit transactions, not the bullshit transaction data that Solana puts out where they're counting all their consensus messages as... Right. Like legitimately to finality, real transactions, 5,000 transactions is only because of the X-Chain we can make that claim. But when you do the account model and things have to be totally ordered in order to run smart contracts like on Ethereum, when you have a totally ordered chain that requires dependency tracking like that, it dropped us down to 200 transactions per second, which is still a lot. It was way better than Ethereum, still way better than Ethereum. And especially with a finality time of less than 2 seconds, right? On the worst case. So this was the challenge was building things that proved that Avalanche can do what we claimed it can do. Part of the reason is because UTXOs are difficult to manage. Dependency tracking on a partially ordered set, really difficult. And also we kept trying to adapt features like NFTs into the UTXO model. And it works. Right, but it's NFTs are significantly better on smart contracts, so a lot of these things that we wanted to make work on the X-Chain wound up being the thing that delayed the protocol probably the most. Everything else was straightforward. Now, after it was released, there was a bigger hurdle, and that hurdle was the need to develop Snowman consensus, which is a derivative of Avalanche consensus. And that was a big problem. So when Avalanche released, everything was fine. There was not a lot of conflicting transactions. There was nobody trying to attack the network. But what wound up happening is the more people started conflicting their transactions with each other, meaning that party A, party B, party C all had different proposals on what was true, different views on the network. The network took longer to come to consensus, right? And so it's easy in the best cases, but when you added all these conflicts on a totally ordered chain, now this would have never happened on the X-Chain or any of Tedian's test cases, but on a totally ordered EVM chain, like the C chain has in Avalanche, the time to come to a decision just kept getting wider and wider. We started having like 30-second finality times all of a sudden. And so what they had to do is develop a new way of managing consensus with a semi-leadered protocol called Snowman Consensus, which ran Avalanche as the base layer. And that actually solved all the problems. And that was actually a challenge that they faced after I left within the first year. But it was not, the hardest part was getting people to acknowledge and recognize and use and integrate and build things that they wanted to use. That was actually the problem. Yeah. And it's a marketing issue. It's not just a marketing, it's an integration issue. Avalanche.js, if it had not been built in a way that I think people will be willing to use it, which is what I built, and I'm stroking my own, but like the petting my own cat, the Avalanche, it probably wouldn't have been easily adoptable for people. They needed Node.js backends. They needed that to also the same libraries to work in the browser. And if that wasn't there, I don't think people could integrate it into their systems or build the cool dApps that they built.
So here, let me ask you a follow-up on that. So let's talk about the vision, as you were building Avalanche versus the reality of today. So, Avalanche was built to be the internet of finance, right? Looking at the ecosystem today, which part of that original vision has surprised you the most and how it's being used or not being used?
Well, the vision for me has always been chains of chains of chains, but that never was everybody else's vision. I believe that things need to be horizontally scalable, not vertically scalable, in order for the world to adopt something. We've seen this pattern time and time and time again, and we keep talking about decentralization, but each chain is a centralization point. It is one database, right? The world needs multiple databases, and it needs the ability to manage the fine details of every single database that they have, especially for optimization. Like if you want to get max speed out of something, you need a VM which is built with intention, right? And siloing is another problem. Like all these databases are these chains are public transactional databases. Well, if I'm running a banking industry and I want to keep my transactions on chain available, but I want to keep them off chain privately, right? I need a way of integrating these chains into the larger network. And that's where the L1 thesis came in. We originally called it subnets. It was easier to rebrand, I guess, to L1s so that people could understand it, but subnetwork is what it is, right? It was an accurate portrayal. We have this larger network, just like, and it's a star network. And then there's these little subnetworks with sub-addressing, and they can create their own subnetworks. Now, the layer below that, they never implemented, I don't think. But the idea was to have this large P chain, platform chain, which basically behaves as a DNS for discovering other chains, right? And then people could build off any other chain they want. What doesn't surprise me is people are too lazy to do that. The value proposition isn't there yet. What does surprise me is they're not exploring it to the degree that I want them to. I'm glad they implemented warp messaging. I think that was an essential way of doing it. You need to have basically bridges between these chains. That was something I knew would come after we released the chain. So as far as I'm concerned, it's actually on track. I think as crypto grows, they're going to be hitting hard limits. I don't mean like soft, I mean hard freaking limits on what they can and cannot do on these chains. And eventually, once those hard limits are reached, these chains will become essentially useless. Which is why just integrating Ethereum, for instance, as a layer 1 subchain under Avalanche makes a tremendous amount of sense. Implementing Solana as a layer 1 under Avalanche makes a tremendous amount of sense. Implementing Bitcoin as a layer 1 under Avalanche actually makes a tremendous amount of sense, because all Avalanche does is allow smooth transfer of knowledge, data, and value between these other chains. It's literally the purpose.
So this is kind of like your EVM legacy, because you were heavily involved with Ethereum, right? The Avalanche Ethereum friendly fork. So
that was a freaking that. It's funny you bring that. That was that marketing lasted like a month, maybe 2. It was an attempt to get people's attention, and it fucking worked. But it also pissed them off, which they did not like. Ethereum accused us of stealing their open source software. It's the most insane thing I've ever heard. Like they open sourced their software. I didn't
know anything like that.
Well, it's because their license was LGPL and they wanted all of our stuff to be LGPL, but we didn't for reasons that we wanted to integrate with business, and business won't allow that. Right. So like we always knew that the end use case here was is the banking industry, is finance industry. It's literally, these are the people we want using this. You want to maximize your token price, you need to be friendly to them. They're not going to accept GPL software. So we wanted to be under a more, I think we MIT'd it. We wanted to be under a more acceptable software license than what they did. So we imported Ethereum as a library separate from our own repo, and used it as a library. And this partitioning allowed us to keep our thing, but then they got kind of mad because they thought it was not in the spirit of the licensing. Well, it's LGPL. The first L in LGPL is library. So like we didn't violate any of their rules. We at first, when we were doing proof of concepts, we kind of did, but like we moved away from that before release. So like this is, they were not happy about that. They feel like we kind of took their hard work but like, what? Like, it's a library, like literally, like.
So here, let me ask you a follow up on that. So about your developer experience, right? Because you've spent over 2 decades as an engineer and a CEO. So if you were going to start a new blockchain project from scratch today in 2026, which part of the standard, I guess you would say, crypto stack would you just throw away immediately?
The EVM. It's not designed for scalability. It can't be designed for scalability. The problem is the EVM is like JavaScript. It's not going away, right? JavaScript is a shit language, right? From its conception. And it was built to be like a little one-off thing, but people started using it all over the place. And they got married to it, and so much code was written for it, it can't go away. And so they just had to build alternative specs to grow it out. The problem is the EVM is built at its very core to not run any pipelining or parallelization, not do any of that stuff. And so it is a literally one after another dependency chain, just like JavaScript is. JavaScript is single-threaded. You can consider the EVM as being effectively single-threaded. And so it won't scale out. The virtual machine is the problem. And so like
that's where the subnets come into play, right? So
correct.
Avalanche's subnets are a really big focus, right? So back when you were architecting the core, how much of this subnet explosion did you map out, or how much was it just an organic response to the limitations of, monolithic chains like EVM?
It just made sense. It wasn't even a response. You don't go into things like this with like I have a vendetta. You go into it with like, how can I build the best thing humanly possible? And like this is that was the goal. Now, my opinion on subnets is, as we called L1s, as they call them now, is every L1 is just an addressing space, just like in a regular network topology. And that addressing space can have multiple databases underneath it, right? It could have little mini delegations there. And not every machine needs to have, and so that to me was like the addressing space was the best way to handle it. I think they went to L1s or just one VM per now, but I wanted multi-chain under L1s for the parallelization pipelining I was talking about before, and that you might want to have a special VM for handling this type of data to partition under this type of data, but you only want one address space from the P chain for discoverability reasons. I think they abandoned that just to get people to adopt. I don't know if that's the case or not. For certain, I just feel like I read that like 2 years ago, but like, cause I don't follow this stuff that much anymore, right? Like there's no value in me getting that deep in the weeds at this point. Right. But from a design standpoint, as a person who understands what works you need to have a P chain addresses your people, your umbrella. And your umbrella can have as many things under it as it wants. And even then, you could create sub-organizations who also have as many things under it as they want. If you have the federal government chain, they need one .gov address, and then they need all their departments to have their own individual partitioned addressing underneath them. And this is actually the case. But what we actually wound up doing is making it a complete star. So you have .gov for whitehouse.gov for mill.gov, like the right, Department of Energy.gov. I think that's dumb, but I also think it works and it doesn't make a big difference. It could in the future, but like that future's so far out, I'm actually not that worried about it. It was a bit of over-designing, I guess, but I honestly think that backing out of that that under-design, is a lot harder than just designing it right from the beginning.
Gotcha. So here, I want to switch gears just a little bit here, Colin, and talk about, yeah.
Just real quick, and this is just breaking news. I just want to pop this in here real quick. Looks like Tron has landed on base. So Tron token liquidity is migrated to Aerodrome via Layer 0. The pool is now live, eligible for emissions, and ready to swap LPs. This is on news of Ethereum. Here soon is going to be on Aerodrome, mainnet. So it's ramping up. That new platform is supposed to be coming out here in Q2 of this year is starting to unfold. So just wanted to pop that in there.
This is great that we've got Colin on right now, Mike, because Colin, what do you know about these VE33 dexes?
You're gonna have to forgive me. I really did drop out of the space for a while.
Okay.
I don't know what that means. So
Okay,
if you want me to look it up, I can. I can tell you probably what it is within. Like so this is the cool thing about having foundational knowledge, is that you can look things up and go, I know what that is. Like, you know what I mean? But I don't know the terminologies that people are manufacturing every day. It's typically just repackaging of old ideas. But you know, with like one little caveat. What is it?
Yes, it's essentially like using a reward token to bootstrap TVL. So it's this whole flywheel, and I mean, look, it definitely works to bootstrap TVL, but I'm not convinced of the long-term validity of having a reward token like that.
I like reward tokens, but I don't think like bootstrapping TVL by saying like, you know, Pepe coin is my foundational like what is, how does that work without a treasury?
Here, let me see real quick if I can just get a description of VE33. I think that'll give you it. So it's vote escrow. So vote escrow 33, and it's the game theory meme from Olympus DAO, originally pioneered by Andre Cronje. With the launch of Solidity on Phantom in 2022, it became perfected by protocols like Velodrome and Aerodrome. So Mike's talking.
I could just hear some names associated with things and go stay away from that. Oh, do you remember? I'm pretty sure I got this Olympia or whatever. It wasn't that the first like magical internet money Ponzi scheme that was run. Like, you remember that?
I think it could have been.
Yeah. I run away from anything that these people put out personally. And that's just because everything they design pumps and then goes to zero.
We got to be clear about this. You know, because they came up with that VE33 model doesn't mean that they're involved with Velodrome and Aerodrome and things like that. It just means that they came up with that model. So let's make sure that we're clear about that.
So here, let me describe, Colin. Let me describe to you what this model actually is, and then you can, make a decision as to what you think about it. So you've got this vote escrow component, and this is borrowed from Curve Finance.
I remember it now.
Yeah. So you're locking your tokens for voting power. You don't just stake them; you lock them, and you receive a vote escrowed NFT for a set period of time, anywhere from 1 week to 4 years. And so the reward in exchange for locking, you get greater voting power. The longer you lock, the more voting power you have. And you can direct those emissions on the protocol. So the voters who have locked up their arrow, let's use arrow in this example, voters who have locked up their arrow to receive the VE NFT, that's the vote escrowed arrow NFT, they can direct which pools receive the protocol's token emissions. So that's the inflation. So that makes you, if you lock up your arrow, that makes you a governor of the exchange's incentives. But remember, those tokens that reward token is inflationary. Now here's the game theory component.
Yes and no. So it depends on how much of the arrow tokens that are bought back by the protocol and burned. So that's a part of that Meta 3 DEX or Meta 03 DEX model that's coming out. So there's a lot more to this than that, and I'm not saying that it's going to be guaranteed to be deflationary or anything like that. But I just want to point out that it isn't necessarily inflationary long term.
I want inflationary. This is what blows my mind is people still think deflationary is good, and I'm saying this as a person who built a deflationary. You don't want deflationary protocols. They all, people think scarcity equals value. Scarcity has nothing to do with value. Making something more scarce, but there's no demand, means that it's just less of something that's worth dog shit. It doesn't matter if something is scarce. You want inflationary, between 1% and 2% inflation. This is what you really want, because you want people to keep working for you to acquire, and it needs to stay within this very small margin of growth. This is true for the US dollar. It's true for these crypto protocols. There's no difference. You need to make things inflationary between a very small margin. And when people think that scarcity equals value, this is the trap. This is
not scarcity alone. Scarcity with demand is value, but scarcity alone, yes, is not value. Because you can have the last dog turd on earth. If nobody wants it, it's worthless. You know,
in other words, you want people to get new supply. They don't want to feel like they're locked out because there's a bunch of bag holders. So think of it like this. If you're early in a deflationary protocol, okay, you have a ton of tokens and you're perfectly happy with whatever's going on forever. All you need to do is generate demand. But the new people don't have an opportunity to gain more tokens, and the people who have don't have incentives to grow the network. It stifles network effects.
So here, Colin, I've got a question for you along these lines. Extracting the signal from the noise, right? So through your work as an engineer and a CEO and a podcaster and in the community, you've seen, probably countless projects, right, come and go. So what's a red flag that tells you that a project is all hype, regardless of how much marketing or VC funding or whatever they may have? What's a big red flag that stands out to you?
All right, well, let's start with promises and yields. Okay, so let's give Luna an example. Okay, Luna promised an algorithmic stablecoin, right? Lunaterra. They promised an algorithmic stablecoin, and they were printing 20% yield. Okay, with nothing backing it. Okay, it's entirely hype driven. There's nothing there. There's nothing there. There's fucking nothing there. And I called it out and got called dumb that I don't understand it, but I just read the white paper on stream and I was called an idiot. And like, if there's nothing there, there's nothing there, guys. Like, there has to be something materially binding you to some sort of GDP growth mechanism, right? And I mean real market GDP growth, right? There has to be some actual economic productivity. Otherwise, it is a Ponzi scheme. Got it? So if you're just using tokens to justify tokens, huge red flag.
Well, that's one of my red flags is if you go and you start presenting facts and logic like you just described, read the white paper of the project online and dissected it, and all you get is the community yelling FUD. To me, that's the red flag. You get
that with Tesla too. I think that's normal human behavior. Okay. And I know you consider it a red flag, but I can't think of a single project, even good ones like Hyperliquid, which, by the way, also has kind of a Ponzi thing going on, but at least they have real GDP use. This is the thing I want to point out. Hyperliquid is different than the other ones. Link is different than the other ones, right? I want correct inflation. Correct, Peter. Link is different than the other ones. Like, think about it. Link does something, right? It builds oracles. People use that data, right? It does something, okay? Utility tokens like Avalanche and Ethereum do something. They actually have a use to build other things on it. It is a platform. It is used, the token is used to prevent Sybil on the platform, right? It's used to prevent flooding. And those are actual use case if there's people who want to build on the platform, right? Link is actual use case if people want to use their oracles. Hyperliquid is an actual use case if people want to do perps trading. Of course, all demand can go to zero. For instance, like Tesla stock can go to zero if people don't want to buy their cars. Same thing, same concept, same idea. But when people are using tokens, which have no value, to justify tokens which have no value and no use case and no productivity increase and nothing that actually contributes to an economy of sorts, a trade economy, to me that screams pump and dump. Yeah.
Well, I mean, I don't want to call those VE33 DEXs pump and dump, but man, there's
still a DEX.
Yeah, there's
that
a
has
DEX.
Value.
There's a DEX, right? And It's just, for me, there's something about that incentive mechanism that doesn't quite pass the smell test. And when I look at other examples of VE33 DEX tokens, they all exhibit the same pattern. It's the same pattern. It's just straight down. And so that makes me think, like, you know.
So this is another thing, by the way. Governance is not utility.
Well, they all have different variables. And again, I'm not saying that, Aerodrome's a sure thing or anything like that, but you have to measure them all independently. Just because they share the same model doesn't mean they have all the same variables. Black hole, it went to shit. What's some of the other ones? The other ones that you guys mentioned.
Ramses and Equalizer.
Pharaoh was another one. Velodrome, is one that never really took off. However, if you look at Aerodrome, there are differences. It is fast becoming a critical liquidity layer for the base network, for Coinbase.
Liquidity. That's liquidity. Right. It's because of the liquidity from Coinbase. That's what it is. That's the only reason why it's surviving, is because of Coinbase.
DEXs are actually utility if they are able to be attractive. But again, just like Tesla, if they stop selling cars, they stop having utility immediately. The liquidity will move, and liquidity is a flaky thing in this space. We have seen many tokens be top 10 and go to bottom 1,000.
You can see liquidity get sucked out of a lot of stuff fast.
Right, and a lot of things pump just to do that. And I don't know what this is doing, but I do know that governance is not going to be attractive to people. When's the last time you voted on your Tesla shares? You know what I mean? Same thing. Like, that's not a selling point.
So what do you think?
And a lot of that's automated. Like my locks, and I'm a big investor in the locks. I have it in the VE Aero Maxi Relay, to where it just votes for me, and I earn yield. And like you guys said, I mean, can it go to zero? Absolutely. I see in a bear market, I see it growing. I see it becoming more and more integrated into Coinbase and into base network. It's like 60-70% of the liquidity that moves on the base network. So that is what I'm looking at personally. Am I saying go out and buy this? No. Do your own research, but this is one of the few altcoins that I see actual growth going on and actual building going on. So,
Bitcoin Mouse,
differences and nuance.
You see what Bitcoin Mouse is saying in the chat? He's trying to offer his condolences to you. He says, "It's okay, Mike. I too am personally victimized by Aerodrome." Like, dude,
I'm not victimized. It's been one of my best earners. It's been one of my best earners out of everything, like Bitcoin included. So keep your condolences.
Yeah, man. So I don't know, Colin, I want to ask you a question here, because this is the hashing it out question. Okay. So as a former host, you've interviewed everyone in the space. What's one question that you always wanted to be asked in an interview, but you never were?
I want to. You know what? I can answer that. What do you think I'm doing wrong? Nobody ever wanted to know what they were doing wrong. Nobody ever wanted to say, "Hey, what is your opinion on this? Hey, why do you think I might be barking up? What would you improve?" They never asked that. They always just wanted to pitch their shit, even the engineers. And none of them ever wanted to say, "Hey, what do you think I could do better?" Like it was a constant, like, hey, pet me. Like, they wanted, and like, even people who weren't building tokens or anything that would make any money, they just had tools they were building. They just wanted to be told they're awesome. As somebody who develops, I genuinely get frustrated because people never tell me what I'm doing wrong or it is important that people, like, so I would volunteer it. Like, I got to the point where I stopped. Like, I would volunteer it. I actually ask some hard questions. And so like a lot of people started not liking me. Like I one of my earlier podcasts, Fabian Vogelsteller gave me my break in Ethereum. Okay. Despite that, he drafted the ERC20 token standard. One of the questions I asked him, which made him just fucking pause, like, how dare you, like, was, what do you think about all these ICOs coming out and how they're being used to grift people? Do you feel personally responsible in any way for creating a standard which enabled people to build things that steal from people? And he did not like that question. And like, so I was not known as being extremely popular. My co-host Corey Petty, who now doesn't talk to me and calls me evil because I supported Trump.
That's a good thing. You're asking the right questions to piss people off. It means that you're asking the right questions.
He calls, yeah. So I don't talk to Corey as of like a few months ago because he's super against ICE and I'm super pro ICE, and like we political reasons literally have just driven a wedge between, I think, what are genuinely people with different ideas on how society should run. And I don't think either side is evil. I think their I think certain perspectives are completely wrong. But like, he and I don't talk anymore, but we ran a successful podcast for a while. He was very well liked. He was very well liked. I would say he didn't ask as many hard questions as me, but he did sometimes. But we had to do it ourselves, and that was frustrating to me because, as you hear, I wouldn't say I'm critical. I would say I'm skeptical, and I like to now analyze things. And like when I hear an idea and I go, this might be a bad idea, or this might not be something people really want, I would say things like, who's your target use case here? But there's also things I didn't know at the time, so I couldn't be perfect on that. For instance, I thought Cadena might actually work, but I didn't know enough about consensus protocols at the time to see why it was a flawed concept. But like, that's part of my growth process. And like this is like the thing. Why don't people ever ask, hey, why does my shit suck? Like, what sucks about this and what can I do to fix it? Like, they don't have to, I don't have to solve that for them, but I could at least go, hey, I have some concerns around this. But nobody ever asked that. It wasn't a very if they did, I don't remember it. It was something I would expect every single founder to do, and almost none of them did it, if any.
So I want to think for a second about what could be coming over the next decade. What's coming down the pipe? We've seen the modular era and we've seen the monolithic era, right? What do you think is going to be that next major architectural era of blockchain? And what do you think it'll be called?
I don't want to be that guy, but I feel like the major problems are solved for the infrastructure side. I think we know what the limits are at this point. I think the adoption side is probably the thing we need to make it usable. It's gross for people to use who are just normal people, but we've always been complaining about that. Ultimately, what people want is a bank. Hello, David. Mm-hmm. Ultimately, people want a banking experience, though. Hello, David. Right. And like this is something that I think people don't like. They just really want it to be literally that simple, right? I think another problem that people are struggling with is self-sovereignty. Yeah. They don't want it. It's not something most people want.
I think you're right.
The 1% want that. And like most people don't want to live that life.
I agree 100%. Yeah.
It's sad.
The self-custody stuff is actually a barrier to entry.
It's a complete barrier.
Which is why Base is actually reasonable, right? Even though it's completely centralized and completely like run by basically Coinbase, like it is going in the direction of banking, and they don't have a token, right? Like
that's good, because you take a look at the other layer 2 rollups like Optimism and Arbitrum that have tokens. For what purpose? What's the purpose for OP or ARB? Those should go to zero. You were saying that governance is not a real use case. Well, hey, that means OP and ARB goes even further to the downside, I think.
And they'll argue against that and say, oh, I know people use this. But it's like, yeah, but that's like what percentage of your actual users? And that's not why they're there. The reason users are there, the literal reason users are there buying your token is speculation,
right, and
not voting. Like, it just isn't. And so, like, ultimately, at the end of the day, people just want a better bank. Like, they don't want, they want a better bank, they want a better market. Well, those problems are solved. So from my perspective, the things that are going to change infrastructurally is making things easier for AI agents to consume quickly and cheaper. And that is the only vector I see right now is automating decision-making processes, and executing on those decision-making processes in a slick way.
Yeah, exactly.
And that's it. It's basically another version of Link, but with it's the integral. So it's like take Link, right, and all their Oracle system, and then take it to the first integral and then the second integral, and that's where we're going to go, right? Like you need to basically see the area under the curve of a Link, and like this is kind of where I think we got to go, and that's where AI agents are going to be like, I'm good now, like I'm really good, like so they're already good.
That must be part of the reason why you built Atigo, right? Mm-hmm. So can you tell us a little bit about Atigo and how agents might be able to use it through X402?
Sure. So you could go to atigo.bid and you can see it right now. It's got a 5, just to show you what it can do. It's got a 5-minute refresh time on the dashboard. If you're a free user, if you become a basic user, it's like $5. You get 30-second refresh downtime. That's all a human needs, right? And refresh time on that dashboard. What I did is I created a Go node to Go dashboard. Okay.
Hold on one sec. So Mike, you see, I've got the screen share of atigo.bid pulled up. I want to see if maybe we can talk through this as Colin walks us through it. So is it going to pull it up? Awesome.
There we go. All right. Accept them cookies. So gotcha. Basically what I got here is a go, no go dashboard. And I don't want to tell you what to do, but I want to tell you whether or not a decision seems to make sense based off of a metric that we created. If you see the scoring methods at the top right corner under the word sign up, I actually created a scoring metric for, you can click it. It actually tells you exactly how this works. And basically what I did is I wanted to condense the data down into something that was almost actionable, meaning it just shows you the directionality of decision-making processes. And that's what go, no go processes in engineering and manufacturing do, right? And so this is a dashboard which basically says, go, there's something interesting here. Look at this, right? And starter means, hey, something is baking here. Maybe take a look at it and keep your eye on it. And then there's no go, which is like, yeah, there ain't shit here, right? And these are only just for confidence layered metrics, right? And so basically it's just another first integral on top of already existing market data, right? In fact, some of that market data is already kind of a first integral in and of itself, like RSI and MACD. So like it just takes that data and says, hey, this is the bird's eye view of that data. And if you close this window here, you'll see that I created this like layered buttons of the, as you can see, the market's pretty dead right now. But if you go to the very top, you click on any one of those tokens, let's just say ETH, and it'll move to ETH's go no go dashboard, right? And right now you're also in low risk. If you go to the very top next to the logo, there's low, medium, and high risk. So you could change your trading. That's why it was all like that. And you change the high. There you go.
Oh, look at that. Go on a short. It's right.
Yeah, on short. high risk. So if you're creating a high risk, profile, this is the higher risk, but it's still not so high risk that everything's green all the time, right? It still says, hey, this is where things are interesting and this is where they're not. And that's all the dashboard does for a human and for AI agents too. But for the AI agents, I actually built humans and AI agents an alert system so that when you sign up and you go to the pro or business plan, you can actually get push alerts sent directly to your AI agents, sent directly to your email. So you don't have to monitor this all damn day long. and it will actually just send you, hey, an email ping. You got to go here on this, and it's all programmable. If you click the profile in the top right corner and go to billing, yep, click that. Oh, really? It should make you sign in. Oh, well, I guess it should make you sign in to see that. I'll change that. You should see the billing like right off the get.
Okay, let me go get that real quick, and then we're gonna sign in. This will be good, man.
Yeah, it's really straightforward, but you could program your own alerts in, and
let me go ahead and sign in now.
So obviously I need that disclaimer that, hey, this is your own risk. This is you doing your own thing. Okay, so you go to billing. I'm actually a little frustrated that billing wasn't upfront. I didn't even notice that till just now. I'll fix that. But you go down, you see the alert metrics in the features, and it'll show you like all the metrics that are available. You can create custom alerts that say, I want this to happen and this to happen, or this to happen and that to happen, or this to happen and that to happen. And it'll when those conditions trigger, it'll send an email to your email. It'll send push alerts to your webhooks, which are good for your AI agents, and it'll literally just tell you immediately, hey, market's doing the thing you want it to do. And you go, okay, and then you can decide whether or not you want to take action on it. And this is literally, so click the arrow next to alert metrics and you'll see the whole list of alert metrics. There's description of everything that it does right down there. But these are all the alert metrics that are available to you. You got spot, perps, go, no go. You got spot, perps, combined score from our scoring mechanism. You got 24-hour over, what's that? Can't read that. Over extension? Yeah.
Over extension.
Yeah. So like I know these terms, but it's just kind of like my brain's reading and it doesn't read well. Short-term impulse, all these things, the sentiment, the long-short ratio, they're all there. RSI, OI change, they're available to you to make a custom alert, which actually sends to you. And if you have an AI agent, it'll send it to your AI agent. All payments can be done in advance. They're done on a monthly basis. There's no subscription. It's literally just load up your account with this much USDC and pay for it. I don't need to know who you are, other than maybe an email address, which is relatively anonymous. And like you can literally just sign up, and even your AI agents can, through the API, which is fully documented and available at the bottom of the site, you just go ahead and sign up.
Oh, so this is how you're running the purchases here. So you're not running it on a subscription. You're just running it. You just like one off. Got it. Okay.
But you can load up as many months as you want or as many years as you want. And if you do a year, it's 15% off. So
got it.
Yeah, it's really just.
Why did you decide to do it that way and not to have?
Because I didn't want to go through Stripe and these people, and I wanted to make it AI agent friendly, and Stripe is not. And like this is just USDC. These are all crypto people already. They should be able to get USDC onto their account. It's just AI friendly. Now I could have done Stripe. Could have like grifted people with like it's not grifting, but like people forget they have subscriptions, you know.
Right.
In this case, if you're not using it, it automatically times out, right? So like you just load up with whatever you're loading up with.
No, but if you do crypto subscriptions,
there's no mechanism for that I found that's reliable. So yeah, but if you go to the bottom of the page, like it's a good dashboard. It shows you, the squeeze risk, relative strength versus Bitcoin, the standard stuff you would kind of see. None of this is really like extreme. But if you go down to the very bottom, there's full docs, parsable and open for the API, and you can see how everything works. You can integrate it with all of your software. I have SDKs available. So there's actually SDKs in Ruby, Go, Python, and TypeScript. You could literally just load up the SDKs, send it to your bot. Your bots could see it on Ruby Gems, or they can see it on PyPy. Go's great, like it doesn't need a centralized authority, and like you could literally see it on npm and install it directly into your existing software packages and start building with this like right now. Even if you don't want to do that and you want to raw dog it with the APIs are completely documented. There are X402 free versions where so you don't actually have to sign up and you just do a one-off payment and get the data. And so these kind of things are available as well. They're more expensive than just signing up, but if you just want to do a quick test to see if this looks good, you could just run a quick X402 payment. You don't even have to sign up, and you'll get that data sent to you whenever you want. And yeah, I mean, like I tried to make it as friendly as possible, especially to developers to integrate with these products. Because if AI agents are the audience, then developers are the audience, because that's all AI agents are. They're just programs.
Yeah.
So like, this is it. And that's what I built.
Super cool, man. This is super cool. I really like it. And I like the idea of being able to, basically connect my agents to like push notifications from Atago, and then have my agents take action based on some custom variable that I set up in Atago. That's pretty cool, man. I like that.
I like it, but what sucks about it? You know what I mean? Like, what can I be doing better? Because adoption's a real big problem for me. I want to make sure.
You able to close us out here? I'm going to jump over to DeFi High with Dom.
Okay.
Yeah, Colin, I'm sure we'll talk about what sucks about it tonight. I'll let you know.
Okay, cool. All right, cool, man.
Oh, no.
All right, guys.
If you guys want to keep talking, go ahead. I'm just going to jump over there. So, David, if you could close us out here whenever you're ready.
Oh, okay. So I didn't know that we were able to like run over and still do the next show with the transfer of the audience, that thing. Oh, okay, great. Well, so Colin, here, if I'm taking a look at this,
sorry, I'm having problems hearing because I'm listening to two shows at the same time. So
it's impossible, man.
I apologize if you ask me something. I'm listening to Don at the same time.
No, it's all good. It's all good. So here, Colin, I want to just ask you a couple of questions about this, and then I do have to run. I'm actually, getting a bank account today for the Node.pro, the business here. And
I had to do all that for Atago. It's the least favorite part. I got to go get that card and activate it, and you got to keep your peas and carrots separate. Yeah,
I know, man. It's a pain, but I got to do that today. I'm, as soon as we stop talking, then I'm gonna be hopping in the car going to both of these nuts, Bank of America, man. So, but taking a look down through this, can you walk me through what the process would look like for me to use this as essentially like a data feed? Like that, that's what I would use it for. I would use this as like a data feed, and I would just feed that data into an agent that is going to trade, maybe it's going to trade one of the handful of assets that you track. So probably like maybe the top 5. Sure. I would really only want to trade the top 5. How would I do that?
So if you look at my screen, I'll go ahead and show you so you don't have to get
awesome.
Go through the billing process. But by the way, we support all the wallets. We automatically detect your wallet and use it so billing is actually pretty straightforward. If anybody has a problem with that, let me know. I'm easy to reach. You can just send feedback at atago.io, not .bid.io, and I'll be able to get to you as soon as possible. So if you go here, so there are API keys available that you can register, and these API keys actually enable you to integrate with your existing software. All you got to do is create a key, give it a name, and that key will pop up. It's just like any other API key system. Okay. You can feed that into your SDKs. Your SDKs can manage all this stuff. You could use your AI agent through Claude Code to just write that stuff, or you could go to GitHub.com, Atago, and there is you can't see that. Hold on, present, share screen. It didn't switch to the right tab, so I'll just show this real quick. If you go to Atago on GitHub, you can see there's actually a full spec for it to ingest. That spec is actually documented out. It's the API spec. It's got MCP endpoints. We got all the REST endpoints. There's authentication flows. X402 payment protocol is all available for anything you want. That's just on the spec. If you go to Atago JS SDK, there's the full Atago SDK that is spelled out. All this is available on github.com/Atago. There's code examples, error handling, all of this stuff is documented very well. And then and we have it for JavaScript, Ruby, Python, and Go, just like I said before. And then if we go back to, let's just say, adago.bid, the alert system enables you to write specific alerts. So you can click up here, go to new alert, search for a token. Let's just say hype, and label is hype, go high risk. And I'm going to set this up so that if spot or perp are a go signal on high risk, you just say spot, go, value, go, high risk, okay. And condition, let's just say that the let's just say, I don't know, sentiment. Sentiment is greater than, let's just say everybody's more than happy about this, right? The sentiment in the market is greater than 50, right? Or spot perps go no go is go and it's high risk, and the let's just go back to the sentiment is greater than or equal to, let's just say 40. I don't care as much about that. Market is real time, so you get the alerts as soon as possible. The reason I put this here is because you don't want alerts to flood your inbox, and sometimes they could trigger really rapidly. Real times means they just happen immediately. And you could also leave an alert timeout, of like 5 minutes, 5 hours, whatever, so you don't get flooded with alerts in your email. But let's just say this is real time. Now I've got hype go, high risk, spot, go no, perps go no for high risk on go. And you just click create up here in the top right, create. And now I've got this hype alert, right? Okay, cool. Now I can add a webhook. Let's just say HBS, the local host 3000, whatever. And it will actually send, anytime there's an alert, it'll actually send. You could copy this secret and actually enable that webhook to be able to decode this webhook, right? So I'm going to delete that webhook. It's not going to work anymore. And that enables your agents to actually ingest this data. All this can happen programmatically. Most of your agents can read my API code and do this themselves as long as they have an API key. You don't even have to do it yourself, right? You just say, hey, Claude Code, integrate Adago platform. Here's their API docs. And it'll go, okay, what do you want to do with it? Oh, I want to receive alerts. Okay, cool. Boom, done. Yeah. Done. Any language you're working with, doesn't matter. Okay, so now you go to account, and I just want to point this out, your notifications, email, push, or webhooks. Email's the default. You'll just enable the webhook notification, and now your AI agents are actually getting the webhooks, right?
Awesome.
And that's it. I mean, this is the sum of it. I try to keep it as basic as possible. You can also register your wallets so that only particular wallets are able to interact with your platform. So, it's just another way of, basically it's saying that these wallets, you need to do this. The reason you add your wallet is because you want your wallets to be registered to your account. So your AI agents using that address will be able to make calls for the receiving of information. So what happens is when an alert goes out, you get the alert, but then you're like, hey, what data triggered this alert? What is the snapshot of the data that triggered this alert? So what you do is you put out an X402 request to the system for a free data push, and it'll actually give you some free ones, or if you want to pay one off, you can. I actually might be able to remove the wallets altogether now that we have the API keys. I'll look into that again. But basically, that enables you to get a snapshot of the data and say, hey, this is what triggered that alert. And then you pass it the reference code. It'll tell you exactly the market status of everything that happened when you got that alert. If you go down to view docs, it'll actually show you what that response will look like. So it's all completely available and very, basically right there. Like this is the data that triggered this particular alert. And it's completely easy for an AI agent to integrate this. And that's again, the dashboard is for people. The emails are for people, right? When you think about it, you're not going to feed your AI agent all your emails and have it checked that way. You want your AI agent to get a endpoint that gets sent that data and then it acts on that data.
Right.
And so that's what this basically does.
You long-winded bastards over here.
Yeah, sorry.
The lesson. Wrap this up. We got tonight.
Okay,
I'm
gonna wrap this up.
But
this is basically the gist of it, and it's not actually that much to ingest. Once you play with it for a half hour or so, you're like, this is easy. I could just do anything I want with this. I never have to troll the markets ever again. It just gets sent to me.
I love that. Especially if I can have an agent take action for me. I love it.
Yep. So what can I be doing better?
This is super.
Other than marketing?
I'll think about it. I'll think about
Yeah.
it. Let me play around with the tool a little bit, and I'll give you some feedback.
Okay, cool.
Oh, Colin, David, let's actually get something on the calendar to actually have a meeting about this, because I think there's some stuff that we can talk about when it comes to this, and let's definitely talk about this tonight, because I think that it plays into a lot of things that are going on with current events.
Yeah.
Perfect.
Yeah. Cool, guys. All right. Well, thanks for having me on. I appreciate it.
Yeah, that was fun. Thank you, Colin.
Yeah, if you ever want a rundown of the basics of consensus protocols, I'd be happy to deep dive into that, but that might be a little dry for the audience.
I don't know.
We definitely need to have you on again, because I mean, you always bring freaking amazing information. I mean, I hate to cut you off. Don's over there, giving the DeFi high lessons. So we want to make sure that we give people
Got
a
it.
chance.
Yeah. So the live redirect doesn't work until we end this call. Yeah.
Exactly. So,
All right, guys.
All right.
Well, thank you for having me on. I appreciate you. I'll talk to you tonight.
Thanks, you guys.
Perfect. Thank you.
Cool. All right.